Okay, let's unpack this. We have a really fascinating stack of source material here centered around a detailed financial analysis framework for Tesla Inc., ticker TSLA.
Yeah, it's quite a deep dive.
This isn't just a company profile. These sources dive deep into the numbers, the strategy, and, what drives market perception.
That's right. Our mission with this deep dive is really to cut through the volume, pull out the most critical insights, and help you understand what the core business is.
Right.
How it's performing financially based on these recent reports, say, up to May 2025, who it's competing with, and importantly, what that eye-popping valuation really signifies.
Exactly. We're looking at recent years' data, but also kind of peering into the near future as outlined in these documents. So maybe forget the headlines for a second.
Yeah.
Let's dig into what the actual data from these sources tells us about this company.
Let's start at the beginning then. What exactly is Tesla, according to these sources? Because the picture they paint, it definitely goes well beyond just electric cars.
Absolutely. I mean, their primary business is still designing, manufacturing, selling those high-performance, fully electric vehicles.
Yeah.
The Model 3, Y, S, X, Cybertruck.
Sure, the cars we know.
But that's really just the foundation now, isn't it?
Here's where it gets really interesting. These documents describe Tesla as increasingly a multifaceted entity.
Multifaceted, yeah.
They detail a pretty significant and growing presence in sustainable energy, stuff beyond the car itself.
Right. That includes energy generation, like solar panels and their integrated solar roof product. And crucially, energy storage.
Yeah, the batteries.
With the Powerwall for homes and then the much larger PowerPack and Megapack systems for commercial and utility scale projects.
Plus, you can't ignore the massive investment in autonomous driving tech, right? The full self-driving software, FSD. That's core to their identity and future ambition as outlined here.
And it all seems to tie back to their official mission, to accelerate the world's transition to sustainable energy. It's not just about electric transport. It feels like it's about the whole ecosystem. This mission seems to really underpin why they've diversified into these interconnected areas.
It does. And the implication for you as someone following this company is pretty significant. It creates multiple potential revenue streams.
More ways to make money.
Exactly. And a much larger potential market, the total addressable market, than just traditional auto. But it also brings complexity.
How so?
Well, resource allocation across vehicles, batteries, software, solar, storage, even robotics now, that's a huge challenge. Where do you focus?
It also explains why just comparing Tesla only to Ford or Toyota feels, incomplete.
Totally incomplete. These sources show they're competing in energy tech, in AI, and potentially even in robotics down the line, with things like the Optimus Robot Initiative mentioned in the documents.
Requires a different lens then.
Exactly. And just for reference, the sources note the key identifying details: Austin, Texas HQ, Palo Alto, California Engineering HQ.
Ah, the dual setup.
Yeah. Likely strategic reasons for that. Talent, operations, maybe. Elon Musk as CEO, of course, and NASDAQ ticker TSLA.
So where do they operate? Let's dive into the markets Tesla is playing in, because the source data has some pretty compelling points here.
Okay, the electric vehicle market naturally is central. The sources highlight its global acceleration. Over 17 million EVs sold in 2024. That's up 25% year over year.
Wow, 25%.
Yeah, and globally, more than 1 in 5 new cars sold is now electric. It's a big shift.
That sounds like explosive growth, and it is an aggregate, right? The market size is substantial, nearly $400 billion in 2024.
Yeah, around $396 billion.
Projected to grow to over $620 billion by 2030. That's about a 7.7% compound annual growth rate, CAGR.
Key drivers are pretty clear. Rising environmental awareness, supportive regulations, government incentives, and obviously battery tech getting better range, charging cost.
But what's fascinating here, as you pointed out, is the nuance in recent growth, according to these sources.
Yeah, it's not uniform growth everywhere.
You mean how that big global number kind of hides some slowing down in key areas?
Precisely. The data points to moderation, maybe even stagnation, in established markets like Europe and the US in 2024. U.S. growth, for instance, slowed dramatically. It was 40% in 2023.
Okay.
And then just 10% in 2024. Big drop.
While markets outside China, Europe, and the U.S. still saw really strong growth, closer to 40%.
Exactly. So if we connect this back to Tesla,
it means for them to keep up that kind of high growth rate the market historically expects.
Yeah, the growth story.
They absolutely need to capture those emerging markets and successfully introduce these new, more affordable models. They need to re-energize demand in those mature regions that are slowing down.
Makes sense.
And that leads us nicely into the renewable energy market where their energy division plays.
Right. And this market, covering solar and storage, is projected for even more robust growth than EVs, actually.
Really? Faster than EVs.
Yeah, these sources estimate a $708.6 billion increase just between 2024 and 2028.
And the annual growth rate, the Train GR, is notably higher here, 13.15%. That's significantly faster than the EV market's 7.7%.
The drivers are a bit different but related. Global energy demand, obviously, energy security concerns, the big push to decarbonize.
Government's helping too.
Definitely. Supportive policies, plus falling costs for renewables like solar and wind. So if we connect this to the bigger picture for Tesla,
it suggests that while the energy division is smaller now, it could potentially be a higher percentage growth engine for the company going forward.
Right. This could influence where they invest internally and maybe how the market ultimately values them over time, perhaps less as just a car company.
And more as a diversified energy and tech play. Interesting.
Given those market dynamics, let's talk about who Tesla is competing with head-to-head. The sources identify this increasingly crowded EV landscape. You've got the traditional giants now getting serious about electric. And a bunch of newer startups, too.
So based on the documents, the top three competitors mentioned prominently are BYD Company, Volkswagen Group, and General Motors.
Okay, BYD, VW, GM. And looking at the approximate market cap and revenue figures from late 2024, early 2025 provides some really crucial context.
Let's hear them. Tesla's market cap is hovering around $1.1 trillion.
Huge number.
With 2024 revenue roughly $97.7 billion.
Okay, now compare that. BYD's market cap is maybe $160 billion range.
Much smaller cap.
But their revenue in 2024 was around $114 billion. So actually higher revenue than Tesla recently.
Higher revenue. Wow. Okay, what about VW and GM?
VW Group, market cap around $55 billion, but massive revenue, $353 billion. And GM, around $47 billion market cap with revenue in the $188 billion range.
Okay, the striking disparity is absolutely clear then. Tesla's market cap is, 7 to 20 times larger than these major global automakers?
Roughly, yeah.
Despite having significantly lower revenue than VW and GM and even a bit less than BYD.
So what's the core insight here for someone trying to understand this valuation puzzle?
It means the market is looking way beyond just current auto sales, right?
Exactly. This premium valuation, it strongly signals that the market sees Tesla as a high-growth technology company, not just an automaker.
They're pricing in the future.
Heavily. Future earnings potential, big market share expansion, and particularly success in those non-auto businesses we talked about. Software, autonomy, energy.
This raises a critical question for you listening. What does this massive premium imply about the risk? If Tesla doesn't meet these incredibly high expectations, the market is already baked into the price.
Yeah, that's the key tension. Let's transition maybe to what gives Tesla its edge, their competitive moats. Right? The things that protect their business from competitors as outlined in these sources.
Okay, moats. They seem to have several distinct advantages. First, their brand and customer loyalty. It's exceptionally strong, isn't it? Almost cult-like sometimes.
It really is. Synonymous with innovation, the future, environmentalism. Their customers genuinely act as brand ambassadors. That's incredibly powerful and pretty rare. Eclipses other EV brands.
Then there's innovative technology and autonomy. They're seen as leaders in battery tech, long-range, fast charging.
Backed by their gigafactory scale, the new 4680 cells.
Right. And those over-the-air software updates that continuously improve the cars. That's a feature traditional automakers are still kind of scrambling to catch up on.
And they are clearly at the forefront of autonomous driving development with autopilot and FSD, leveraging just a massive amount of real-world driving data, the sources mention, over 1.5 petabytes.
Their Supercharger network is another key moat, wouldn't you say? It's extensive, reliable, and directly tackles that range anxiety hurdle for drivers.
Definitely. But what's fascinating here is the recent strategic shift mentioned in the sources, opening up that network
to other car makers using the NACS standard.
Exactly. Like the Hyundai Ioniq 5 now comes with the NACS port.
That seems counterintuitive. Doesn't it dilute their exclusive advantage? Why give that away?
Well, it could dilute the exclusivity aspect, sure, but think about it, it also potentially creates a whole new revenue stream.
Charging non-Tesla EVs to use the network.
Precisely. It might be a calculated trade-off. Maybe slightly reduce exclusivity, but you gain a new source of potentially high-margin service income. Turn that asset into a profit center.
Interesting. Then there's vertical integration and manufacturing efficiency. They control so much of the value chain, don't they?
Yeah, in-house design, producing key components like batteries and motors, the software, assembly, even direct sales.
What does that give them?
More control over production, for one. Maybe more resilience against supply chain hiccups. The ability to iterate and innovate faster than companies relying heavily on external suppliers.
The sources mention things like unboxed assembly aimed at cutting costs, too.
Right. The challenge, of course, is that they bear the full R&D and capital expenditure burden. It's expensive to do it all yourself.
Success depends on constant innovation and keeping costs down, then.
Exactly. Cost leadership is key if you're vertically integrated like that.
Their software ecosystem and that potential for recurring revenue feels huge, too. FSD software is a prime example, whether you buy it outright or subscribe.
Oh, yeah. Analysts cited in the Sources project really substantial high-margin recurring revenue potential from this software alone. Some estimates go as high as $20 billion annually by 2030.
$20 billion from software subs.
Yeah.
That's a tech company revenue model, not an auto model.
Precisely. And finally, leveraging their battery expertise into energy storage solutions. Powerwall, PowerPack, Megapack.
Right, using the battery know-how beyond just cars.
Positions them strongly in that rapidly expanding grid and home energy storage market we talked about earlier. Another growth factor.
Okay, let's get into the numbers themselves. Section 5 here dives into the financials from these sources, covering the last 3 fiscal years, 2022, 2023, and 2024.
Right, the recent track record, starting with the income statement. Total revenue. Let's say $81.5 billion in 2022.
Okay.
Grew to $96.8 billion in 2023.
Solid growth there, almost 19%.
Yeah, 18.8%, but then a dramatic slowdown. In 2024, revenue was $97.7 billion.
So barely up from 2023.
Less than 1% growth, 0.95% to be exact. Essentially flat revenue last year. That's a big change.
And net income. How did profit hold up?
$12.6 billion in 2022. Grew nicely to $15 billion in 2023.
Okay, tracking revenue growth.
About 19.4% growth, but then it plummeted in 2024. Down to $7.1 billion.
Whoa, cut by more than half.
Yeah, a massive decline of 52.7% from 2023 to 2024. And these trends are corroborated by more recent reports and that Q1 2025 update mentioned in the sources.
Which showed revenue down 9% year over year.
And operating income down a stunning 66% year over year. Really sharp drops.
So the critical takeaway here is a really abrupt shift. They went from a period of high growth and improving profitability.
The narrative everyone loved.
Straight into a phase of stagnating revenue and, frankly, collapsing net income in 2024 and early 2025. For a company valued so highly on growth, this is a major, major signal.
Huge pressure on margins in 2024. Okay, moving to the balance sheet. What's the story there?
Total assets show consistent investment and growth. $82.3 billion end of 2022, $106.6 billion end of 23, and $122.1 billion end of 24.
Reflects building those gigafactories, investing heavily in R&D, all that stuff.
Total debt also increased from $3.1 billion to $5.2 billion to $8.2 billion over that same period. Though the sources note this includes both current and non-current debt.
Okay, so debt is rising, but still seems relatively low compared to the asset base.
Yeah, and compared to equity. Total stockholders' equity grew substantially, from $45.5 billion to $63.4 billion to $73.6 billion.
Where's that equity growth coming from?
Largely fueled by retaining earnings, especially from those earlier, more profitable years like 22 and 23, plus other capital changes.
So the balance sheet narrative, then, is still a company in a significant growth phase.
Definitely investing heavily.
But funding those investments primarily through its own earnings and equity, rather than taking on huge amounts of new debt. It generally looks pretty healthy from a structural point of view.
Now let's look at a few key ratios. These give us insight into how efficiently the company is operating and its financial strength.
Exactly. They help interpret those raw numbers.
First, return on equity, ROE. Measures profit generated per dollar of shareholder equity. It was very strong.
Yeah, impressive numbers.
33.2% in 2022, 27.6% in 2023. They were very efficient profit generators back then.
But then, mirroring the net income drop, it saw a significant contraction in 2024, falling all the way to 10.4%.
Ouch. So much less efficient profit generation from that growing equity base.
Right. Could be due to ramp-up costs for new products like Cybertruck, maybe increased competition forcing price cuts, the macro environment. Lots of potential factors.
Okay, what about liquidity? Can they pay their short-term bills? We look at the current ratio for that current assets divided by current liability.
And that actually showed steady improvement, 1.53 in 2022, 1.73 in 2023, and up to 2.02 in 2024.
So consistently above 1.0 and getting better, especially getting above 1.5 towards 2.0. That suggests pretty strong short-term financial health, right? Plenty of liquid assets.
Absolutely. Strong liquidity position, improving trend.
Finally, leverage. How much debt are they using? The debt-to-equity DE ratio of total debt divided by total equity.
And this remains remarkably low, 0.068 in 2022, 0.083 in 2023, 0.112 in 2024.
Very low numbers. I think the sources mentioned a slightly higher figure, like 0.18 maybe for May 2025, depending on calculation, but still very low overall compared to industry peers.
Yeah, extremely low. Those numbers signal a very conservative capital structure, minimal reliance on debt financing. It indicates financial prudence and relatively low risk from debt compared to many large corporations.
So what does putting those ratios together tell us for you following this company?
Well, it means that despite those significant recent challenges on the profitability front, the ROE drop.
Right, the income statement issues.
Tesla's balance sheet and liquidity ratios paint a picture of underlying financial strength. Improving current ratio, very low DE.
So they have flexibility.
Exactly. Financial flexibility to handle short-term shocks, to fund their significant investments, or even to engage in competitive pricing battles if needed without having to take on major new debt burdens. That's a key strength highlighted by these financials.
Okay, now let's tackle the elephant in the room. Understanding Tesla's market valuation. Specifically, those super high multiples based on the source's data from late May 2025.
Right, the valuation piece. Let's look at the key ratios. The price to earnings PE ratio is approximately 190.5. The sources mention a range, but it's way up there, like 160 to 190.
Just astronomical compared to most companies. What about price to sales? PS?
Around 10.5. Again, maybe a range noted around 10.5 to 11.5 in the documents.
And enterprise value to EBITDA?
EBITDA.
Around 66 based on the sources. These are all standard tools analysts use to gauge valuation relative to earnings, sales, cash flow.
And now compare these to the valuation table against BYD, VW, and GM from the sources. It's stark, isn't it?
It's night and day. The difference is absolutely massive across every single multiple. Tesla's PE around 190. Competitors are maybe 5 to 27.
Huge gap.
Tesla's PS around 10.5. Competitors are down at 0.15 to 1.3. And EBITDA around 66 for Tesla versus maybe 8 to 10.5 for the others. So this extraordinary premium across all metrics, it strongly suggests the market has exceptionally high expectations, right?
Unbelievably high expectations for Tesla's future growth,
Right.
revenue growth, profit growth, market dominance. It's not just pricing in continued auto sales. It's heavily banking on that tech leadership, the successful deployment of FSD and RoboTaxi, and massive expansion of the energy business.
And this is where that valuation directly translates into risk for you as someone watching this. It implies considerably higher risk if those future expectations aren't met.
Exactly. And the recent stock volatility, especially after those weaker results and delivery numbers, is a direct reflection of this sensitivity. The market reacts hard when the growth story hiccups.
What's fascinating here, I think, is how this extreme premium means the stock price is probably far more sensitive to news about those long-term transformative drivers.
Yeah, the big picture stuff.
The success of SSD, the affordable EV ramp-up, RoboTaxi plans, energy advances, than it is to just whether they sold an extra 1,000 cars this quarter. Is that fair?
I think that's exactly right, based on this analysis. Delays, failures, or setbacks in those futuristic projects could cause much more severe stock price corrections than for a traditional auto company whose valuation is mostly tied to current performance.
This raises an important question, though. Tesla's sky-high PE of around 190 is happening at the exact same time as its net income. The E in PE actually declined by over 50% in 2024.
Yeah, the math gets weird there.
If earnings continue to fall or even just stagnate, doesn't that PE ratio actually expand even further unless the stock price comes down significantly?
It has to, mathematically. To sustain this kind of valuation, you absolutely need strong, consistent earnings growth. And the recent performance directly challenges that requirement. It's a core tension.
Okay, let's turn now to the company's strategy, the risks they face, and some recent events highlighted in the sources. The sources do a quick SWAT analysis: strength, weaknesses, opportunities, threats.
Right, standard framework. Strengths are things we've discussed. Brand, tech, vertical integration, superchargers, leadership.
Weaknesses. The recent financial volatility and that net income drop are big ones. Manufacturing or quality issues like recalls. High product costs still,
Right.
CEO controversies, maybe high turnover, sometimes mentioned.
Opportunities include the expanding EV and energy markets overall, the huge potential if FSD RoboTaxi pans out, launching that affordable EV, hopefully in H1 2025, continued battery tech advances, and maybe the Optimus robot long-term.
Threats. Definitely intensifying competition, which could erode market share, economic downturns, geopolitical risks like trade tensions or tariffs.
Big ones for a global company.
Regulatory scrutiny, especially around autonomy, supply chain and raw material volatility, and that reliance on Elon Musk again.
The sources specifically pull out the top 3 risk factors from Tesla's 2024 annual report. Competition is number 1.
From established automakers and new EV entrants globally. Could hurt market share, pricing power, profits. Makes sense.
Second is that reliance on Elon Musk. Highly dependent on his vision and leadership, his loss or even just negative perception could materially harm the business, prospects, brand, maybe even talent retention.
And it's amplified, the sources suggest, by his public persona and his involvement in so many other demanding ventures. SpaceX, xAI, Neuralink, Boring Co., even DOGE was mentioned.
Yeah, raises questions about potential conflicts, resource allocation, his focused attention on Tesla versus everything else, and succession planning.
The third key risk relates specifically to autonomous driving, FSD.
Right. Significant technical hurdles still exist to get to unsupervised FSD, plus complex regulatory, legal, and public acceptance challenges.
So delays, failures, or negative government actions here.
Could severely impede their commercialization plans, especially a RoboTaxi. That would hit growth projections hard and weaken a key point of differentiation versus competitors.
And these risks are interconnected, aren't they?
Yeah.
As competitors get better at making just plain good EVs.
Right, the gap narrows on the basic car.
Tesla's differentiation increasingly relies on its tech advantage, like FSD. If FSD is delayed or disappoints, that moat weakens.
And it forces them to compete more directly on traditional autometrics price, features, quality, where legacy players might actually have some advantages in scale or manufacturing experience.
Leading potentially to more margin pressure, slower growth, directly challenging that valuation premium we keep coming back to.
Exactly. It all ties together. Now, Tesla's official growth strategy, as outlined in these documents, is clearly designed to address these risks and try to justify that premium. It's very ambitious, very multifaceted.
It includes significant product line expansion and a focus on affordability, beyond just ramping up this Cybertruck.
Which has its own challenges.
The sources mentioned the crucial, more affordable EV plan for the first half of 2025, sometimes called Model Q or Baby Model Y, using mixed platforms on existing lines, it seems.
And the RoboTaxi, the Cybercab, targeting a launch before 2027, maybe around $30K cost, features like wireless charging.
That's a big piece of the future vision.
Huge. Tied into that is aggressively pursuing FSD advancement and commercialization. The goal is unsupervised FSD, launching a RoboTaxi service in the U.S. potentially later in 2025.
This year. That seems ambitious.
Very ambitious timeline mentioned. And expanding supervised FSD availability to Europe and China in 2025. This is absolutely pivotal for generating that potential software revenue and launching new mobility services.
They're also focused on manufacturing innovation, like that unboxed assembly concept.
Yeah, trying to lower production costs. The sources mention a COGS target below $35K in Q4 2024. Cost leadership is crucial with rising competition.
The energy business expansion is another major stated target, identified as potentially their fastest growing segment and a significant future profit contributor, not just revenue.
Right, higher margins potentially there. And they're investing heavily in AI and robotics, increasing AI compute power dramatically in 2024 for FSD development.
And working on the Optimus robot, initially for their own factories, but with long-term product ambitions.
That seems to be the plan. Plus, continued focus on supply chain localization and vertical integration to reduce risks and control their tech, and leveraging their direct-to-consumer model and Musk's public profile for marketing.
The sources also provide analyst consensus estimates for fiscal year 2025 for revenue and EPS growth. And the revisions here tell a story, don't they?
They really do. Early 2025 expectations were quite bullish. Analysts were looking for around 19.5% year-over-year revenue growth and maybe 30% EPS growth for FY 2025.
But then reality hit. Like the Q1 miss.
Exactly. And current projections as of late May 2025 are dramatically lower. Revenue growth now expected around 9.4%.
Cut in half.
And EPS growth around 4.6%, with a consensus target maybe around $2.55 per share.
But it's worth noting the sources show a really wide range of EPS forecasts still, from as low as $1.42 up to that $2.55. That signals a lot of uncertainty among analysts, right?
Huge uncertainty. That swift, dramatic reduction in analyst expectations just demonstrates how sensitive the stock and outlook are to negative catalysts like that Q1 performance. It's typical for companies priced so heavily on a future growth narrative. Performance misses trigger swift, sometimes brutal recalibrations. The wide EPS range reflects differing assumptions about everything new: model ramp costs, FSD, progress, competition, margins, the macro climate, potential for big earnings surprises, positive or negative.
Speaking of Q1, let's quickly touch on some recent news and catalysts from roughly December 2024 to May 2025 mentioned in the sources.
Yeah, the Q1 2025 results in April were definitely a pivotal event. Deliveries down 13% year over year, production down 16%. The sources called it the weakest performance in 2 years.
And financially, revenue down 9%, operating income plunged 67%. They missed EPS expectations. Dario and reported versus their altered 27 cents expected in some sources.
And this immediately triggered those downward analyst revisions and heightened concerns about slowing growth and margin pressure we just talked about.
So in the face of that, Tesla seemed to double down on the affordable EV and RoboTaxi narrative between January and May.
Exactly. They reiterated plans for the affordable EV launch in the first half of 2025, and Elon Musk unveiled that cybercab RoboTaxi concept.
Targeting launch before 2027, $30 K cost, wireless charging.
He framed 2025 as a potentially seminal year for FSD progress, and even mentioned plans to launch the RoboTaxi service in the US later this year.
Again, very aggressive timeline.
Extremely. These announcements about future products are absolutely central to the long-term narrative that underpins the valuation. They serve as the counter-narrative to the recent financial weakness. But success hinges entirely on execution and meeting these timelines. Big if.
Other ongoing issues mentioned include Elon Musk's public engagement and those geopolitical tariff trade issues. Reports of him maybe focusing more time on Tesla were seen as generally positive.
A potential positive signal, yeah. But the complex trade landscape persists. U.S.-China tensions are ongoing. The EU considering tariffs on China-made EVs definitely impacts Tesla's global production footprint and costs.
The sources mentioned Tesla actually filed a suit against potential EU tariffs and paused U.S. Model SX orders in China.
Yes, these are real headwinds affecting their global cost structure and market access strategies, not insignificant.
Finally, smaller but still relevant, the 2025 spring software update included features like adaptive high beams for the US, dashcam viewer improvements, UI tweaks.
These updates, while maybe not groundbreaking, are important because they demonstrate that continuous improvement via OTA updates. That's a key part of their customer appeal and differentiation mode, keeping their existing fleet feeling fresh and their technology competitive.
Okay, let's quickly touch on leadership, governance, and ESG as outlined in these documents before we wrap up.
Sure. Elon Musk's background is covered: co-founder of PayPal, founder of SpaceX, early investor and CEO of Tesla, plus all the other ventures.
Yep.
XAI, Neuralink, The Boring Company, even his past role with DOGE is noted.
And this extensive list brings us right back to that significant key person risk we discussed. His multiple demanding roles create unique governance considerations.
Potential conflicts of interest, resource allocation dilemmas.
Raises questions about his dedicated focus on Tesla compared to everything else, and frankly, succession planning.
Looking at institutional ownership, Vanguard Group is consistently identified as a main shareholder, holding around 7.67% according to the sources.
What's the implication of large passive holdings like Vanguard?
Often means less active challenge to management decisions compared to activist investors. This can enable bold, long-term bets from someone like Musk, but also potentially allows less scrutiny of governance practices or resource allocation choices. Musk retains considerable influence.
Finally, their ESG performance: environmental, social, and governance. The Sustainalytics ESG risk rating as of March 2025 is cited as medium risk with a score of 24.8.
Which ranks them 31st out of 85 in the auto industry. And their management of ESG material risk is rated as just average.
That seems surprising. Yeah. For a company literally built on accelerating the transition to sustainable energy, a medium risk rating feels notable.
It does suggest that maybe operational practices, governance structures beyond Musk's direct influence, or specific environmental aspects outside their core product might not be perceived as best in class by these ratings agencies.
And an average management score points to potential areas for improvement in formalizing systems, transparency, maybe addressing some of the more challenging ESG topics head on.
Okay.
It's a bit of a paradox for a company often seen as a leader in sustainability itself.
It is a bit paradoxical.
Okay, so bringing all of this together, the core business beyond cars, the market dynamics, the tough competition, those competitive advantages or moats, the recent financial performance and key ratios, that sky-high valuation premium, the significant risks, and the ambitious strategy. Let's try to distill it into the core bull versus bear cases presented in these sources.
Okay, the concise bull case really emphasizes Tesla's continued market leadership and that incredibly strong, almost fanatical brand loyalty.
The tech edge, too.
Absolutely. Technological superiority in battery tech, FSD development, AI capabilities, their expanding global manufacturing footprint, and focus on efficiencies like unboxed assembly, those growing moats, the Supercharger network, the massive potential for high-margin software FSD, recurring revenue.
The energy business growth.
Right, the rapidly growing energy business offering diversified growth, and then the exciting future growth vectors. The affordable EV, the RoboTaxi dream, Optimus, and underpinning it all, the driving force of Elon Musk's visionary leadership.
Okay, now the concise bear case. It has to start with that extreme valuation, right? Those incredibly high multiples compared to peers just imply a level of future perfection and execution that leaves almost zero room for error.
A very high bar. Then there's the intense competition, which is clearly eroding market share and pressuring margins. We saw that directly in the recent financials.
Execution risk feels big, too.
Huge operational execution risks. Can they actually hit production targets for new, complex products like Cybertruck or the affordable EV? Ensure quality. Meet those incredibly ambitious timelines for FSD and RoboTaxi deployment.
Plus the cost of all this growth.
Massive capital expenditures are needed. And that significant key person risk around Musk, his multiple roles, the controversies, the focus questions, macro and geopolitical headwinds are real threats too. Demand slowdown, supply chain volatility, tariffs.
And crucially, that recent undeniable slowdown in revenue growth and the sharp decline in net income in 2024. It directly supports many of these bear arguments, doesn't it? It gives them credence.
It definitely makes the bear case more tangible right now. So Tesla, based on these sources, is undeniably a complex, almost paradoxical company. It's a revolutionary force, clearly a leader in the transition to sustainable energy.
Significant inherent strengths. The brand, the innovation, the ecosystem they're building.
Absolutely. But these sources also lay bare the very real current challenges. That clear slowdown in financial performance in 2024 and early 2025, the erosion of profitability, and the reality of increasingly intense competition that is catching up fast.
And as we've hammered home, that incredibly high valuation absolutely requires successful execution of their very ambitious future projects.
The affordable EV has to work. FSD needs to progress towards commercialization. RoboTaxi needs to become more than just a concept. The energy business needs to keep expanding rapidly.
The risks are significant. Just meeting those lofty expectations is hard enough. Managing the operational complexities of being in multiple cutting-edge industries simultaneously, the unique governance considerations around Elon Musk, and those areas needing improvement, like their noted ESG performance.
So for you listening, if you're investing in or just following this company, you have to weigh the potential for truly transformative disruption against those considerable execution risks, the intensifying competition, and that demanding valuation that offers virtually no margin for error based on recent performance.
That recent sharp recalibration of analyst expectations for 2025 really underscores just how sensitive the outlook is right now, how quickly the narrative can shift.
Definitely.
So let's leave you with a final thought, drawing from everything we've unpacked today from these sources. Given that significant decline in net income we saw in 2024, happening at the exact same time as Tesla is projecting massive spending on future growth drivers like AI, the affordable EV, RoboTaxi, and Optimus, how might the market ultimately reconcile the need for huge investment now with the imperative for strong and consistent earnings growth that's needed to sustain its current high valuation premium?
Yeah, how do you pay for the future while also delivering the profits the current price demands?
What does this fundamental tension imply about the potential volatility and maybe the investor confidence challenges ahead for this truly unique and, let's face it, constantly fascinating company?